Friends, thank you for being here today. We stand at a precipice in modern financial history, a moment that future economic historians will likely mark as the definitive end of one era and the chaotic beginning of another. It is January 14th, 2026. While the world outside continues its daily routine, commuters rushing to work, algorithms trading stocks in microseconds, and politicians debating the news of the day, a structural fracture has occurred in the global commodities market that defies the fundamental laws of modern finance. Specifically, within the silver market, we are witnessing an event that technically, mathematically, and historically should be impossible in a free market. We are not discussing a mere price fluctuation, a transient spike in volatility, or a fat finger trading error. We are witnessing the breaking of the pricing mechanism itself, the disintegration of the trust that holds the global financial architecture together. The subject of our analysis today is the unprecedented, violent divergence between the Eastern and Western markets. As of the close of trading, the spread, the price difference between the Shanghai Futures Exchange, SHFE, and the COMEX in New York has exploded to $13 per ounce. Shanghai silver has hit $104, while the New York spot price trails at roughly $91. In a functioning, efficient market, this gap should not exist. The fact that it does, and that it is widening hour by hour, serves as irrefutable evidence that the global financial system is no longer operating under the rules of logistics and arbitrage, but rather under the severe constraints of a physical liquidity crisis. To understand the gravity of the situation, we must set aside the sensationalism often found in financial media and look coldly at the data. We must adopt the mindset of a forensic accountant or a crash investigator. We must ask ourselves why the most sophisticated banking institutions in the world, entities that employ the brightest mathematicians and possess the fastest trading infrastructure, are leaving billions of dollars of risk-free profit on the table. Why are they not closing this gap? The answer to that question reveals that the banks are not merely passive observers of this phenomenon. They are the architects of a system that has finally escaped their control. They are trapped by the very mechanism they built. To fully grasp the magnitude of this event, let's begin by dissecting the anatomy of this market fracture. Let us look at the data, for numbers provide a clarity that rhetoric cannot. As of the market, close on Wednesday, January 14th, 2026, the divergence is no longer a theory. It is a statistical reality. The Shanghai Futures Exchange, which has increasingly become the center of gravity for physical price discovery, closed at approximately $104.55 per ounce. This price reflects the intense demand from the Chinese industrial complex and a citizenry rapidly moving capital out of the yuan. Simultaneously, the COMEX spot price in New York, the historical benchmark for Western paper contracts, hovered around $91.67. This results in a spread of approximately $12.88, which we round to $13 for the sake of our discussion. In the context of commodity trading, this is a statistical anomaly of the highest order, a 6 sigma event. Silver is a fungible commodity. An ounce of silver in a vault in Manhattan is chemically identical to an ounce of silver in a warehouse in the free trade zone of Shanghai. It is element 47 on the periodic table. It does not vary in quality like crude oil or coal. Therefore, the law of one price suggests that, adjusted for transportation, insurance, and tariffs, the price of an identical asset should be roughly the same globally. To put this $13 spread into perspective, we must look at historical norms. In the gold market, the spread between London, LBMA, and New York, COMEX, is typically measured in pennies, often less than 50 cents. When it widens to a few dollars, arbitrageurs step in immediately. In the copper market, a spread of $1 might emerge during severe logistical disruptions, such as a strike at a major Chilean mine or a blockage in the Suez Canal. However, a $13 spread on silver, roughly a 14% premium, is unprecedented in the modern era. This spread is not just a number on a screen. It acts as a thermometer for the health of the global market. A 14% differential indicates a complete decoupling of the two markets. We are no longer looking at a unified global price for silver. We are witnessing the bifurcation of the world into two distinct spheres. The paper market in the West, dominated by futures contracts where price is determined by leverage, and the physical market in the East, dominated by manufacturers and savers, where price is determined by the immediate availability of the metal itself. I'm curious to know if you are seeing this bifurcation in your local area. Are your local coin shops honoring the spot price, or have premiums exploded to match reality? Leave a comment below with the street price in your city. I want to crowdsource this data. This data point is the smoking gun. It proves that the pricing mechanism in New York has lost its validity. When a commodity trades at a 14% discount in one major financial hub compared to another, and that discount persists and widens, it signifies that the cheaper market is broken. It suggests that the price displayed on Western screens is no longer a reflection of reality, but rather a fiction maintained by a lack of physical delivery and a surplus of paper promises. This naturally leads us to the critical question of why this gap hasn't closed, which reveals the death of arbitrage and the mechanics of the failure we are witnessing. In a functional market, a mechanism called arbitrage ensures that prices remain aligned. Arbitrage is the immune system of the market. It attacks inefficiencies. Arbitrageurs are traders who scan the globe for price discrepancies. If silver is $91 in New York and $104 in Shanghai, the arbitrage trade is obvious and theoretically risk-free. One would buy physical silver in New York for $91, arrange secure transport to Shanghai, and sell it for $104. They would pocket the $13 difference, minus perhaps $0.50 for shipping and insurance. This buying pressure in New York would raise the price there, and the selling pressure in Shanghai would lower the price there until the two prices met in the middle. This is how markets have self-corrected for centuries. The fact that this is not happening today tells us that the mechanism of arbitrage is dead. And it is dead for a terrifyingly simple reason. The metal is not there. We must conclude that the blockage is not logistical. Global shipping lanes are open. Air freight is operational. We can move sophisticated electronics, perishable vaccines, and luxury goods around the world in less than 24 hours. The inability to move silver is not a failure of transportation. It is a failure of supply. When banks or traders attempt to source physical silver in New York to execute this arbitrage trade, they are finding the vaults empty. To understand this, we must look at the inventory data of the COMEX. The COMEX divides its silver inventory into two categories, eligible and registered. Eligible silver is stored in vaults, but not available for delivery against a contract. Registered silver is the actual liquidity available for delivery. Over the last 18 months, the registered category has plummeted to historic lows. It has been drained by entities who saw this crisis coming. What remains is a thin veneer of liquidity. When a bank tries to buy 5 million ounces to ship to China, they are told the metal is not available or that there is a delay of months for loadout. You cannot arbitrage a price difference if you cannot get your hands on the asset. Furthermore, we face a regulatory trap that has exacerbated this bifurcation. The new export licensing system in China, which went into effect on January 1st, has created a Hotel California dynamic for precious metals. Silver can enter China, but it cannot leave. The Chinese government, recognizing silver as a strategic metal crucial for their dominance in green energy and high-tech manufacturing, has effectively nationalized the flow of silver. This destroys the incentive for Western banks to engage in arbitrage. If a bank ships metal to Shanghai to capture the $104 price, they are paid in yuan. But due to capital controls and the inability to convert that yuan back into physical metal for export, their capital is trapped. Thus, the bridge between the East and West has been incinerated. We are left with two floating prices. The Western price of $91 is a paper price, relevant only to those trading cash-settled contracts. The Eastern price of $104 is the physical price, representing the cost to actually acquire the metal. The failure of arbitrage confirms that the Western financial system has run out of the physical collateral necessary to back its paper promises. Beyond these structural mechanics, we must also address the failed intervention and the impotence of policy we saw unfold over the last 24 hours. On Tuesday, January 13th, the CME, Chicago Mercantile Exchange, raised margin requirements by 15%. For those unfamiliar with futures trading, margin is the amount of cash a trader must put up to hold a contract. In standard market dynamics, raising margins is a tool used to cool down an overheating market. By requiring traders to put up more capital to hold their positions, the exchange forces leverage speculators to sell, driving the price down. It is a soft form of market manipulation, often used under the guise of maintaining orderly markets. This was a calculated move, likely intended to protect the solvent status of the banks holding massive short positions. The expectation was a sharp sell-off that would bring the price back under control, perhaps pushing it down to the mid-80s. However, the intervention failed spectacularly. While there was a momentary dip, the market absorbed the margin hike and proceeded to rally higher. This is a behavior seen only in the late stages of a currency crisis or a hyperinflationary event. It indicates a fundamental shift in the composition of the market participants. When a margin hike fails to lower prices, it tells you that the buyers are not leveraged speculators. Speculators use 20x leverage. If margins rise, they must sell. Real buyers, industrial users, and sovereign wealth funds pay cash. They are not using leverage. The buyers driving this market are industrial giants like Tesla, Samsung, and defense contractors who need silver for electronics, missiles, and solar panels. They are sovereign wealth funds from the BRICS nations, diversifying out of failing fiat currencies. They are high net worth individuals in India and China protecting their generational wealth. These buyers do not care about margin requirements because they are paying in full and taking delivery. They are not playing a game of price speculation. They are securing a critical resource. The CMES attempt to use a financial lever to solve a physical shortage was a category error, confirming that the establishment has lost control. This brings us to the most dangerous aspect of the current situation, the bank trap, or what we might call the short squeeze of the century. For decades, major Western banks have profited by shorting precious metals, selling contracts they do not own with the intention of buying them back lower. This naked shorting strategy works well in a market with ample supply and low demand. It essentially allows banks to create paper silver out of thin air to meet demand, keeping the price artificially low. However, a short position in a commodity market carries a unique and infinite risk profile. When you short a stock, the worst-case scenario is that the stock goes to zero and you profit 100%. If the trade goes against you, the stock price can rise, but it is theoretically capped by the company's valuation. When you short a critical commodity during a shortage, there is no upper limit to the price. If a bank is short silver at $30, $50, and $70, positions established years ago, and the price rises to $100, they are facing billions in losses. To close your position, you must buy the metal or the contract. But buying the metal drives the price even higher, increasing your losses on the remaining shorts. This is the classic short squeeze, but on a global, systemic scale. The banks are now trapped in a death spiral. They cannot cover their shorts because there is no physical metal available to buy in New York at any price. If they attempt to buy large quantities, they will push the price to $150 or $200 instantly. They cannot arbitrage the Shanghai price because of the export bans. They are staring at technical bankruptcy. They have only two catastrophic options: force majeure, effectively defaulting and destroying the credibility of the dollar, or facing uncapped losses that could require a Federal Reserve bailout, hyperinflating the currency. I want to hear your prediction on this. Do you believe the Federal Reserve will bail out the bullion banks to save the system, or will they be forced to let them fail to save the currency? Type bailout or default in the comments section so we can gauge the sentiment of this community. To understand that this is not merely a technical glitch in a New York futures trading, we must look to global corroboration, specifically the view from the real consumers in India and China. India serves as the ultimate barometer for physical silver demand. The Indian populace views silver not just as an industrial input, but as money of the people. The data coming out of India is staggering. The local price has smashed through 290,000 rupees per kilogram. When converted at current exchange rates, this equates to approximately $132 per ounce. Let us pause and reflect on that number. New York says silver is $91. Shanghai says silver is $104. India says silver is $130. The Indian price represents a massive 45% premium over the Western paper price. This is the street price, the price one must pay to actually hold the metal. Furthermore, reports indicate that major bullion dealers in Mumbai and Delhi are completely sold out. Refineries are refusing new orders. This is a panic. The Indian population, with thousands of years of institutional memory regarding currency collapse, is fleeing fiat currency. They are not waiting for Wall Street to give them permission. They are trading their labor and their savings for metal at any price available. Similarly, China's role is critical. China controls the vast majority of solar panel manufacturing. Modern solar technology, specifically TOPCon cells, requires significantly more silver than previous generations. China knows that to dominate the energy transition, they must control the silver supply. They are not buying for jewelry. They are buying for national security and industrial dominance. The $104 price in Shanghai is not speculative. It is the bid price of industrial survival. However, we cannot view this silver squeeze in isolation. It must be understood within the broader macroeconomic context, which is fundamentally a crisis of confidence. Simultaneous to the explosion in silver prices, we are seeing gold hit new all-time highs of $4,144 per ounce. We are seeing Bitcoin hold above $80,000 despite regulatory crackdowns. Most alarmingly, we are seeing a spike in U.S. Treasury yields. The 10-year Treasury yield has surged from 3.8% to over 4.5% in a matter of weeks. Bond yields rise when bond prices fall. Bond prices fall when investors sell them. The world is dumping U.S. government debt. This is the ultimate vote of no confidence. For decades, the U.S. Treasury bond was considered the risk-free asset, the bedrock of the global financial system. Now, investors are treating it as a source of risk, worried about the U.S. debt-to-GDP ratio and the weaponization of dollar sanctions. They are selling bonds, paper promises, to buy hard assets like gold, silver, land, and commodities. The Federal Reserve is trapped in the same checkmate as the commercial banks. If they raise interest rates to defend the dollar, they crash the real economy and make national debt interest payments unsustainable. If they lower interest rates or restart money printing, they accelerate inflation and the flight from the dollar. There is no good exit. The smart money sees this, which is why they are draining the silver vaults and positioning themselves for a paradigm shift where tangible assets become the only safe harbor. Some of you may be asking about alternatives, so let's look at the industrial reality and why substitution is not an option. Skeptics often argue, if the price goes too high, industry will just use less silver. This is the argument of substitution or thrifting. In 2011, when silver hit $50, industries did exactly that. However, by 2026, we have hit the laws of physics. Silver is the most conductive and reflective metal on Earth. For high-performance electronics, 5G, 6G towers, EVs, and advanced solar cells, there is no substitute that offers the same efficiency. Copper oxidizes. Gold is too expensive. Furthermore, the amount of silver in an iPhone or a Tesla is small relative to the total cost of the product. Even if silver goes to $500 an ounce, the cost of producing an iPhone might go up by only $10 or $20. Apple can absorb that cost or pass it on. They will not stop making iPhones because silver is expensive. They will pay whatever price is necessary. This inelastic demand is the nightmare of the short sellers. Unlike jewelry demand, which falls when prices rise, industrial demand for critical technologies is rigid, ensuring the price floor is solid concrete. To truly appreciate the uniqueness of this moment and why the current squeeze is terminal for the paper shorts, we must contrast it with history, specifically the events of 1980, and understand the geopolitical weaponization of reserves. Many of you will recall or have studied the great silver spike of 1980, driven by the Hunt brothers. At that time, silver reached $50 an ounce. The establishment response was swift and brutal. They changed the rules. The exchange declared liquidation-only trading, effectively forbidding anyone from buying new contracts. They raised margins to 100%. They crushed the Hunt brothers because the Hunts were leveraged speculators operating within the casino of the West. They were vulnerable because they were playing with borrowed money on a playing field owned by their adversaries. However, drawing a direct parallel between 1980 and 2026 is a fatal analytical error. The entity squeezing the market today is not a pair of eccentric Texan oil barons using leverage. The whale in the market today is a hydra-headed monster consisting of sovereign states, strategic industries, and a global retail awakening. Consider the distinction. You can margin call a speculator. You can force a hedge fund to liquidate, but you cannot margin call the People's Bank of China. You cannot issue a liquidation-only order to the Ministry of Defense. You cannot force Samsung to sell the silver it needs to produce the next generation of microchips. The buyers today are not speculating on price. They are accumulating strategic reserves. They are paying cash. They are taking physical possession. They operate outside the jurisdiction of the COMEX rulebook. When the exchange changes the rules today, these buyers simply shrug and move their liquidity to Shanghai, which is exactly what the spread tells us has already happened. If any of you lived through the 1980 Hunt brothers era, I would value your perspective. How does the current market atmosphere compare to those days? Is the panic palpable yet? Or is this still the calm before the storm? Share your experience below. This sovereign squeeze is further complicated by the geopolitical dimension. We are seeing the weaponization of commodity reserves against the US dollar. The BRICS nations have explicitly stated their intention to settle trade in hard assets rather than fiat currency. In this new monetary order, he who has the gold and the silver makes the rules. Silver is not just an industrial metal, it is becoming a strategic monetary asset once again. Russia and China are not hoarding silver to sell it for a profit in dollars. They are hoarding it to exit the dollar system entirely. This removes the selling pressure that typically ends a bubble. In a normal bubble, buyers eventually sell to realize profits. In this scenario, the buyers are buying to never sell back into the currency they are fleeing. Furthermore, we must address the fundamental supply deficit that has plagued this metal for decades, a deficit that has been masked by the liquidation of above-ground stockpiles. For the last 5 consecutive years, the world has consumed significantly more silver than it has mined. We have been filling this gap by draining investor stockpiles and recycling old material. But those stockpiles are now exhausted. The low-hanging fruit of available silver bars is gone. We are now eating into the bone. This physical reality manifests in a technical phenomenon known as backwardation, which we are seeing flare up across the yield curve. In a normal market, future prices are higher than spot prices to account for storage and interest. This is called contango. Today, we are seeing the opposite. Spot prices are screaming higher than future months. The market is effectively saying, I don't want a promise of silver in 3 months. I will pay a premium to have it right now. Backwardation is the death rattle of a futures market. It signals that trust in future delivery has evaporated. When you combine a structural supply deficit with an unbreakable, unleveraged demand from sovereign entities, you create a perfect storm that no amount of paper manipulation can suppress. The banks are not fighting a market cycle. They are fighting geology and geopolitics simultaneously. So, what does this mean for the immediate future as we face the endgame scenario? We are entering the final stage of the paper suppression of commodity prices. The bifurcation of the markets is likely permanent. We will continue to see a volatile, disconnected paper price in the West that becomes increasingly irrelevant, while the physical price in the East continues to climb. The COMEX will essentially become a zombie market, trading paper ghosts while the real action happens in Shanghai, Dubai, and Mumbai. Eventually, the paper market will break. It may happen through a default, a force majeure declaration, or a sudden violent repricing where the COMEX price gaps up to meet reality overnight. Imagine waking up to find silver trading at $150, not because it slowly climbed there, but because the exchange revalued it to prevent a total drain of the last ounce. When this break occurs, the price moves will be vertical. We are looking at the potential for silver to reprice to $150, $200, or the $375 target, possibly within this year. In closing, friends, remember that the spread is the signal. The $13 spread between New York and Shanghai is not a clerical error. It is the siren of the geocentric financial system cracking. It is the mathematical proof that the Western banking system has overplayed its hand, issuing more paper claims than there is metal in the earth to satisfy them. The arbitrage is dead because the metal is gone. The banks are trapped because the leverage that once made them rich is now an anchor dragging them toward insolvency. The East has woken up and is draining the West of its remaining real wealth. If you are an observer of these markets, understand that the price you see on your screen, the $91 ticker, is a lie. It is a reference price for a contract that cannot be fulfilled. The real price is what a desperate industrialist in Shanghai or a frantic saver in Mumbai is paying right now. The real price is $104. It is 130 tucks, and soon it will be much higher. The window to acquire physical assets at paper prices is closing, if it hasn't closed already. We are witnessing the greatest transfer of wealth in modern history, from those who hold paper derivatives to those who hold physical resources. The spread is the signal. The collapse of the paper paradigm is the result. And you are watching it happen in real time. Now, I leave the final question to you. Are you holding paper or physical? And what is your price target for the end of 2026? Let's get a discussion going in the comments. I read every single one. Thank you for your time, your attention, and your courage to face this critical shift in our economic reality.